All right, guys, warm welcome to another week ahead video. This week's video will cover the trading week running from Monday the 7th to Friday the 11th of November 2021. Now, we have a very light schedule coming up in terms of economic data points. The main highlights will be the US CPI data coming up on Wednesday. And then on Thursday, of course, we've got quarterly jobs data in focus for Australia. Now, this past week, we had the RBA's decision, of course, and that can be summed up as hawkish indeed, but dovish in word, because the bank scrapped yield curve control as well as their date-based forward guidance in favor of a more flexible state-based guidance. But Governor Lowe offered a very familiar dovish tone, playing down markets' expectations for earlier hikes as soon as next year. Now, currently, there's still a few positive and negative factors in play for the Aussie dollar, which could create a very attractive short-term trading opportunity with this week's upcoming quarter three jobs print. It does mean that the fundamental outlook is still neutral, though, given that there's a lot of positive as well as negative drivers in play. Now, taking a look at some of these drivers, the first one always need to be said, of course, is China. Trade with China is very important for Australia, with almost 40% of all exports going to China alone. So the recent slowdown that we've had in the Chinese economy has really been a key factor driving downside in the Aussie dollar, and rightly so if you look at this trading relationship. Now, the current COVID outbreak in China, which once again saw large parts of the country locked down, is another point of concern, something that we do want to be keeping on the radar for the Aussie. But it hasn't just been all bad. Of course, recently we had the recent PMI data in the form of the Caixin PMIs, as well as the trade data over the weekend, showing some signs of life when it comes to the Chinese economy. And of course, news over the weekend as well, suggesting that the energy crisis in China is easing slightly, with only a few provinces now still contending with outages. So it's not all negative, but definitely on balance, still tilted more to the negative side for the Aussie dollar. In terms of the monetary policy side, the RBA, like we said, stuck to a very dovish tone last week, which was Aussie negative, but still, they did still tilt incrementally hawkish away from looser policy if you just compare that with where we were just a month ago, and that is more Aussie positive. So on that front, it does seem that the bond market has also been painting a rather mixed picture. If you take a look at the 2-year yield differentials for the Aussie, it still favors the Aussie. But if we take a look at the 10-year differentials, that of course has been pushing to the downside, showing a different picture. Now, do keep in mind that a lot of this can be explained by that mini tantrum we had in the Aussie bond market just 2 weeks ago, after the RBA decided to defend the yield curve target. We saw a huge push to the downside in Aussie bonds, and that obviously saw massive rips to the upside in two-year yields on the Aussie side, especially the bulk of the short end of the curve absolutely smash it to the upside. So a lot of that upside can be explained by that phenomenon. Some of that 10-year moves as well, but on balance, we can see it's a very mixed bag now with what the rate differentials are showing us between the 2s and the 10s. Now, there's also, of course, the COVID situation to keep in mind. Even though the recent outbreak caused a slowdown in quarter three, that downside is all but priced in right now. And furthermore, if Australia does follow the same pattern that we've seen exhibited across the globe for other countries that's gone through these waves, then we could be in store for a nice solid bounce back in the economy. The one negative, though, aspect on that front is that the RBA has in their recent communications sounded less convinced of the speed as well as the size of that expected Q4 bounce back. So that is definitely one to watch. It means the incoming data will be incredibly important for us in the weeks and sessions ahead. The other key driver, of course, always to keep on the radar for the Aussie dollar is commodities, where iron ore, the one in yellow, has continued its recent descent and is now well over 57% down from that year-to-date highs. So just a massive push lower. Now, this is a concern for two reasons. Firstly, because it's Australia's biggest export at 24%, but also because coal prices, the one in orange, has also been starting to fall recently. Keep in mind that coal prices were able to largely offset the fall we saw in iron ore, because that is the second biggest export at 18% of exports. So the fact that we had that big rip to the upside in coal prices while iron ore prices was moving lower it offset a lot of that negative impact on terms of trade. But now with both of them tilting to the downside, that is obviously a negative and something that we do need to keep in mind. Now, when it comes to iron ore, though, the counter here is that, like we said, we are starting to see some minor signs of life when it comes to the Chinese economy, as some of the recent data points. And if we do see China starting to improve, iron ore prices should see some reprieve from that, and that is definitely something worth keeping on the radar. There's, of course, another caveat, though, when it comes to coal prices, and that is overall energy costs, which has been driven up recently by that energy crisis. So recall that the reason for that big push, not only in coal, but in oil and natural gas, coal, all of that, has been due to the energy crisis. And there's been huge demand from the coal point of view from China. So if the news over the weekend is correct and the energy concerns are indeed starting to ease in China's side, that should see coal prices continue to ease as well. So definitely want to keep in mind. Lots of trades off here, as you guys can see. Turning to the positioning side of things, the one positive factor for the Aussie is the sizable net short positioning for large speculators as well as leverage funds. Now, despite some unwind that we've had in some of that positioning, it is still arguably sizable for both large specs as well as leverage funds. And that means that arguably there should be less resistance on positive news compared to negative news for the Aussie dollar. And that means that there could be more momentum from economic data points that beats expectations than misses expectations, just because there's still a big sizable chunk sitting there in terms of net short positioning. So on the risk sentiment side, the other factor to keep in mind is that equities have been looking very stretched recently. We've been seeing a lot of push to the upside, and even though the medium-term outlook for equity still remains intact, still remains constructive, if we do start to see a little bit of unwind in some of these very, stretched, arguably stretched moves, that is, of course, a negative factor that we need to keep in mind for the Aussie dollar from a high beta point of view, from a risk sentiment point of view. Now, apart from that, that also brings us then to the economic data, where the focus in this upcoming week will be on that Q3 jobs print, with consensus expecting a print of 50,000 on the headline and also a print of 4.7% for the unemployment rate. Now, we, of course, had a big drop with the previous quarter's data, or previous month's data, coming in at negative 137K. It was mostly driven by the Victoria state lockdowns, but wasn't as bad as some economists that had previously predicted it to be. So it came in slightly better, even though it was a monster of a downside print at negative 137. Now, if we take a look at the recent high frequency data, things like the job adverts, things like business surveys, it does paint a slightly more optimistic picture, which means we could be in store for a possible beat coming into this data. For example, Westpac Investment Bank, they actually expect a contraction coming in with this week's data point of negative 50, where consensus expects plus 50. But they do acknowledge that there is a lot of upside risk to that print due to the recent high frequency data that we've seen. So overall, given our neutral fundamental outlook for the Aussie dollar, a beat, like we said, given positioning, will arguably have a bigger impact in the Aussie. But with all the other mixed drivers in place, a solid beat or a solid miss could offer some decent short-term trading opportunities, and that'll definitely be in focus for us in the week ahead. So, guys, we hope everybody will have a fantastic week ahead. As always, any questions, please don't hesitate to let us know.